What's up, traders? I'm here with my good friend and trader, investor, Ben Sparham. We're going to speak about markets, a few things, how crazy these markets have been in actually the last month or so. Ben, how are you keeping?
I'm doing well, man. I'm doing well. How you doing?
Yeah, all good. Can't complain my side. Just a bit busy with the youngster, with the Lati, but yeah, no, it's a blessing, bro. It's a blessing. How's everything your side? How's life? How's the markets been your side?
Yeah, everything's good. My end markets aren't too bad for me because of the way that my portfolios have been structured recently and stuff, or just generally are structured most of the time. But obviously, we'll get into that in a little bit. Just trying to catch up from the lack of sleep after the Masters over the weekend. But it
Yeah.
was worth it to see the Grand Slam, so I can't complain.
Oh yeah, well, it's the first Grand Slam in 25 years since Tiger Woods did it in 2000, right? So, 100%. I mean, that's probably. I am a little bit sick at the moment. I don't know if you guys can hear, but so it probably is from staying up Friday night. I didn't stay up on Thursday night, but Friday night, Saturday night, Sunday night. I will say this though, is that I actually had two picks. You know the Yanks, bro. They were like, "Oh, Bryson," and I was like,
Yeah,
dude, Rory not getting this far. I don't think he's getting this far in choking now. Yes, we've seen him choke and whatever,
tried.
but yeah, sure. But I was like, I actually had two picks after Justin Rose was up on day one. I had Justin Rose as my pick and Rory. And to be fair, I actually felt bad for like when it was the playoff. I was like, oh no, he's gonna lose because Justin Rose lost to Sergio in 2017 playoff. I was
Yeah,
like, oh no, he's gonna lose in a playoff again because you know. And then he hit that great shot, and then I was like, I even said to my friend, I was like, dude, this guy's gonna stuff it to 5 foot to make a birdie. I said, and he did it. So it
exactly.
was a bit of a sad one, but Justin just shows that golf is such a beautiful game because you can still be playing an elite level at 44 years of age,
Yeah.
and I think that's the great thing about markets as well. Is that you only actually get better with time. That's what I love
Mhm.
about trading and markets is that like it's not like something that you get in your prime. It's like no, the every single day that you learn and you see different markets. I mean, I've been seeing markets like this. I've been trading relatively new, I would say 8 years. I started in 2018. So this will be 8 years at the end of this year. I've never seen markets that are having 1,000 point swings on the Nasdaq to the high side and then on a fake tweet and then comes back down 1,000 points again. So it's been pretty wild. How have you been keeping? I know that your portfolio is kind of like, if I'm correct me if I'm wrong, but kind of like just at break even, while the Nasdaq and that are down like 20%, 15% this year. So speak to us a little bit about that.
Yeah, so I obviously run a few different portfolios and stuff like that that have different structures, slightly different structures to them. But the core concept is always based around a multi-asset approach, right? So the bottom line is that the majority of my capital allocation, I don't need to predict markets in any way, shape, or form. So the idea is you have different asset classes that have different levels of correlation to each other and perform differently in different economic conditions. And then there's obviously different ways that you can then structure that, i.e., like volatility adjust weighting. So, i.e., if we keep a very simple example, if you had stocks and bonds, stocks are typically 1.5 to 2 times more volatile than bonds. So, you would have roughly 1.5 to 2 times more bonds in your portfolio for them to have an even impact in terms of portfolio performance, right? So, that would be one way of doing it. You can obviously volatility weight it. You can obviously change the weighting as more of a tactical allocation, depending on what your sort of macro and world view is, i.e., you think you're particularly bullish equities at the moment, so you want to have a bigger portion of your portfolio to equities, for example. So, you can obviously run things in different way, but one of the ways that I do it, like with Darwin X, I've got a very low risk portfolio on there. And that's actually up 3.34% this year
Nice.
when the S&P is obviously down. I mean, anything up
15.
to like 21% at one point. I know it's not
Yeah.
as far down as that now, right? But the idea is that it creates a much smoother equity curve. It might lag a little bit during massive bull markets because you have other asset classes in there, but it also has a much tighter dispersion and standard deviation. So it's just a much smoother ride over time, basically.
Yeah. It's what basically long-term investors, guys that are looking for retirement accounts, they want not wanting 25%, 30% drawdowns and P&L like the Nasdaq can sometimes give you.
Yeah.
My long-term portfolio, I literally keep it simple, Ben. I dollar cost average into a few, mutual funds, and then the S&P and the Nasdaq ETFs. But mine's down year to date, obviously, because most of it is in the
Mm.
S&P and Nasdaq. But I do have a few other mutual funds that I do long-term invest into. But that's kind of like as a DIY retirement investing, it's the best thing to kind of do. Is, I'm not trying to manage too much stuff. I'm just trying to like dollar cost average into it, and that's basically my goal with that.
Yeah.
I must say though, so I did purchase. So we did a video in January, and Ben, if I do recall correctly, told me to buy Google, and Google's down 18%. So my whole portfolio is down 18%, and I decided to throw the kitchen sink at your recommendation.
I hope you put your life savings into it.
Yeah, putting my life savings in one stock. Yeah, no, that's maybe that we've spoken a lot about this, and my mate always, I'm going to visit my folks back in East London, not in London, in the UK.
London.
In East London, I was born in a town called East London, and I obviously currently live in Belito. But I'm going to go visit them with my son and everything like that. And my one mate that I'm going to go play golf with there is he's a financial planner and everything like that. And we've spoken a bit about this, and he always we always have good chats. But he's saying now is possibly a good time to buy long term, where we're at. What are your thoughts on that?
Yeah, I think at the end of the day, we know the stock market over time is always going to do the same thing. It's going to go up and to the right? Because at the end of the day, it's comprised of businesses that over time always earn more money. The likes of your Googles, Amazons, Microsofts, etc., and obviously many other up-and-coming companies and businesses as well, right? So they're always going to earn more money, so therefore the valuations end up higher, and therefore the market ends up higher. Now, obviously, what's going to happen in the next 6 months, the reality is nobody knows for sure. We structure portfolios so obviously based around different probabilities, but nobody knows for sure where it's going to be. So when you're looking at a long-term view, you're just basically, working it towards the fact that, okay, I don't know where things are going in the next 6 months, but I know over the next 10 years we'll be up and to the right. So any time that you get a correction, a dip, 10, 20, 30%, whatever it might be, it's always going to be a fantastic time to buy over the long term. Now, does it end up being that, we buy today and can the market move lower? Well, of course it can. But then you just buy a bit more and you buy a bit more and you just dollar cost average. And then eventually when the market then does turn, you end up obviously making a nice bit of money. I mean, a prime example of that is if you look at a chart of, say, the S&P, you go back to like the late 90s, early 2000s when we had the tech bubble, obviously. We peaked up, then we had obviously a large drawdown of over like 50% when we had the tech bubble burst. And then obviously in a number of years, we got back up to the same kind of level as the peak around 2007, 2008. And then we had that massive sell-off of the GFC. So it was something along the lines of about 13 years. If you'd have bought the peak around about 2000, it was about 13 years before you obviously ended up higher than that, right? But if you'd have been dollar cost averaging, you'd have been making money a lot quicker because those times when the market was moving lower, you're bringing your average price down and down and down. So it's a lot quicker to then go and make money. Plus, you now have more money invested. So not only do you have a lower cost base, but you have more capital in there as well. So you kind of create this compounding effect there, and then you make a lot more money. So, this is where a lot of people go wrong. They just buy in the good times and they never buy during the bad times. So they're always buying at higher prices and they'll make money, but they're never going to make it anywhere near as much as they could do if they were just kind of consistently adding to things.
Correct. I actually every single Friday I typically do my dollar cost average into my mutual funds and ETFs. I like to keep it simple. I have like 2 mutual funds that I invest into and 3 ETFs. I like to keep it simple. I use Satrix for those South Africans. I use Satrix ETFs in South Africa, the Satrix Nasdaq ETF, the Satrix S&P 500 ETF, and the Satrix MSCI World Feeder Fund ETF. Those are the 3 ETFs that I use, and then I use a couple of other mutual funds that are managed and everything like that. But that's more like basically is also like a portfolio that during the down times they try and manage it to keep it like pretty stable. It's not like a growth portfolio. So I want to just show guys this, and as I said, every Friday our dollar cost average, I've actually doubled my amounts that I put into my dollar cost averaging every Friday now in the last 2 months because markets are down. I don't want to be buying more when I'm at all-time highs. I want to be buying more when we've had a little bit of a pullback, because then when we get to all-time highs, then I'll maybe drop it down and go back to my usual amounts because I'm getting in at more at a better price now for my longer. And again, I'm probably not going to touch this money for at least 20 years, call it that. So I'm not thinking about tomorrow. I'm literally, one of my positions was quite crazy, Ben. This market has been wild. I literally bought quite a lump sum on the Friday or on the Thursday. I decided to do it. On the Friday, it was up 8% on an ETF.
Oh, that was when the S&P rallied like 10% in a day,
Yeah,
didn't it?
I thought I was trading. I thought I was like, geez, this is not a trading app. I was 8% up. Yeah, pretty wild, bro. Pretty wild.
Yeah. Yes, it's the best thing to do. It's about consistency, and whatever it is for that person, whether it be monthly, quarterly,
Yep.
whatever it is, right? I mean, I've got friends of mine, for example, they're very simplistic approaches. They had the same amount every month. Let's imagine it was $200, right? And then if the market drops 10%, they make a larger one-off purchase on top. If it drops another 10%, i.e., 20%, they make a larger one-off purchase on top. But they just keep their regular monthly payments as well at the same time. It's just if you get a larger than normal drop,
You
i.e.,
add.
technical correction or entering a bear market, etc. They then make additional purchases on top, and it just is a fantastic way of taking advantage of those lower prices, like you said.
Yeah, I just want to show this, and then I want to get into your portfolio and your take on markets, but on where we're at. But basically, if you started, yeah, let's get our screen up here like this. So if you start with this is a compound interest calculator, okay, and this is Albert Einstein said the eighth one of the world is compound interest. He who understands it earns it. He who doesn't pays it. Now, I was actually having a conversation with one of my friends, and they said that I said, do you want to become a millionaire? They said, well, who doesn't want to become a millionaire? I said, yes, but it's going to take you about 50 years. And he said, no, that's boring. I want to go on skiing trips, skiing holidays now, not when I'm 70. I'm going to have buckled knees. I said, yes, but I'm just saying for long-term retirement, this is not the fanciest. Yes, you want to increase your income. Your biggest wealth generation tool, and quoting Dave Ramsey, is your income, right? So if you can increase your income, you are obviously going to be able to get to your goals faster, have more investment. But I'm talking like a long-term retirement, because many people get to 60 years old, 65 years old, and they're like, shit, I could live another 20 years here, but I've got $2,000 saved to my name. Oh, because you didn't think you'd actually get there. And this is not great. So this is what I'm saying. If you start with, let's just say $2,000, okay? $2,000. And on average, the S&P 500 does about 10% in a year for the last 50 years, okay? And let's say for the next 50 years, and every single month, you just put in $150 every single month. At the end of that amount, at the end of this compound interest amount, you will have 2 million, almost call it $3 million for 50 years. If you just do this simple formula, that's how much you'll have at the end of that, right?
Yeah. And the best thing is you can automate it. You don't even have to be doing it like with most of the things like Vanguard, etc. Like I've literally got friends and family that are set up. They set it up once like 5 years ago, and they've never ever done anything again. Like when people talk about passive income and all that kind of stuff, right? This is the most passive type of investing you can ever do. You set it up once, never touch it again. And don't forget that obviously these types of things, they typically spit off about 1.5% a year in terms of dividends and stuff like that. So, you could still be getting a bit of a dividend income and a passive income when people talk about passive, right? And stuff like this. So, if you were sitting there with a couple of $1 million in there, spitting off, 1.5% a year in dividend payments, you could still let that compounding take effect and be paying yourself out the dividend, and you're not interrupting the compounding. So it's a fantastic way of doing things.
Look at this growth though. After about 20 years, you haven't really done much. Look what starts to happen after year 30. You from year 40 to 50, you exponentially grow. So this is just something I like to show guys in terms of like a long-term portfolio. If you just want to be secure later on down the line, if you're making a great income, particularly if you have a great source of income, if you're making more than $10,000 a month, right? Particularly in South Africa, in a third world country, you should 100% be doing this, because if you're not, you're just being silly. You want to go purchase other things, and you should first do this, and then you can maybe go.
I mean, you change that now, right? Even if you still started at the 2K, if you change that to $500 a month that you was putting in, right? If you put that to 500, you watch how much this is going to jump.
Watch this. So that was 2.9, call it 2.9 million. By the way, look at out of the 2.9 million, look how much interest you actually earned.
Yeah, pretty much all of it. Yeah, you've only actually put about 100 grand in. Yeah.
Yep. So look at this. Okay, now let's calculate. By putting $500 in a month, well, you're going to have 9 million. So just that extra $350 every month by not getting that car payment that costs $350, or getting a cheaper car that doesn't cost $1,000, it costs $350. Yes, you don't look like the hero now, but you'll look like the hero later, and your family will very much appreciate that money when it's late, comes to later down the line.
Exactly that. It happens all the time. People tend to kind of spend first and then save and invest what's left. They should be obviously firstly taking care of essentials, i.e., you know what sort of money you need for bills that are actually essential bills. I'm not talking about Netflix subscriptions, but actually essential bills. Then you can sit there and say, right, well, based on what's left, I want to invest X amount of it and save X amount of it. And then that leaves me this little bit here that is now my play money. I can spend it on whatever I want, dinners, buying stuff, you know, whatever your preferences are. It's not like you have to do one or the other. You don't save and invest everything and not live, or you go on wild holidays all the time and don't save and invest. You know, you kind of find a middle ground where you can still enjoy your life. You know, you still need to live. There's no point being the richest man in the graveyard either.
Yeah.
But, you know, you want to create a healthy balance for yourself so you don't cause problems down the line. And like you said, you know, the thing with investing and compounding it especially is, you know, you don't really notice the effects of it so much at the beginning. You know, you started with $2,000, you make 10% that year, it's $200. You've got two now in the next account. You sit there and think, fucking all year, $200. What the hell's that? But as we've just seen there, you know, 50 years down the line, when you've got millions in there. Yeah, you've only got to look at someone like Warren Buffett's net worth, right? That chart of his net worth, he's worth a few million and that throughout his 30s and stuff. And then all of a sudden it just does this because of the compounding effect. He's now worth over 100 billion. So it's, you know, it's just
And
the way
I think
that
there was
works.
actually a stat, Ben, if I'm not sorry to interrupt, I think there was a stat that he only became like 90% of his money came after his 60th birthday or something like that.
Something like that, yeah, about around 50s, 60-ish, something like that. Yeah, 90% of his wealth has come after that because obviously you're then compounding a larger number.
Yeah.
So the jumps that you get from a monetary value aspect are much, much bigger.
Yeah. I mean, look at this. Just after 1 year, I just tried $250 at starting with 10,000 at 10% a year. After 1 year, you'll have $5,000. I mean, you would have your total interest that you would have made that year is $350. That's not a lot of money at all. But then look how much interest you'll be making. Interest after 20 years, you'll be making $142,000 worth of interest a year after 20 years. That is triple the average salary in America of interest.
Yeah, well, there we go then. That's just in your interest, right? And then you can get to a point where you have like a safe withdrawal level. So if you've got an investment that returns, say, on average 9 to 10% like the S&P does, well, you have like a safe withdrawal level of, say, about 3% per year that you could pull out.
Correct.
Some of that is pure dividend anyway, and then a little bit of that is obviously on the appreciation. But you're giving yourself a buffer by where you're still able to compound. It's not taking too much out of it during any kind of down years that you have, and it's still growing over time. But, you know, if you do something like that, for example, you could probably quite comfortably end up taking out 40 to 50K a year, you know, and all of a sudden you've got a salary, right? So you're 20 years down the line now and you have a salary. You have an amount of money there that you're able to now just consistently pull out. Your investment is still going to grow as well. So you'll actually be able to still take out a little bit more next year, a little bit more the year after that if they're both up years. But you're now in a position where if you wanted to, depending on what your lifestyle is like, you could probably actually never work again.
Yeah, agreed. I mean, that's fantastic. Pulling out 50 grand a year just on withdrawals because of something you started 20 years ago. That's brilliant. You know,
crazy, isn't it?
For most people in a third world country like South Africa to pull out $50,000 a year just on and still keep, let's say, 100,000 out of the interest that you earn that year, that's fantastic. You could live a pretty comfortable lifestyle on that by
even having in the developed world, right? If you look at the average wage in London is only about 44K a year, right?
Wow.
So if somebody was pulling 50K a year, they are above average wage and do not have to do a thing for it. They can lay in bed till 10 o'clock every day if they want. I wouldn't recommend it, but if they wanted to, they could do. They could just go and see their family. They could do whatever they want, right? And they could still live a normal person's lifestyle because they're earning more than the average person. So you know, there's no reason why you can't do that in the developed world as well. Now, of course, if you want a more lavish lifestyle, of course, you'll have to wait a little bit longer. Maybe you have to get to year 30 or, you know, you have to be hustling a bit harder and investing more each month as opposed to just the 250 or whatever it might be, right?
Sure.
But as long as
tailor your goals, see what your goals are, and then figure out how much you need to invest.
Exactly that, right? You've got to make it personal to you. And at the end of the day, the more you put in, the more you're going to get out, the quicker you get to that retirement goal. So that's essentially the way that you have to approach it.
Okay, Ben, let's, in the last bit, let's speak about your portfolio. How are you managing that? How have you been managing that? And maybe, maybe let's see what are some stocks that you are looking at maybe for that you are thinking of adding to your portfolio more or maybe taking out of your portfolio? Let's get yours up here.
Yeah, I mean, for me, when I'm looking at obviously any kind of individual names,
Yep.
I'm always going to be focused on the high quality businesses at sensible valuations, right? We're always
Mag
going to think
7
about that
stocks,
in the
right?
long term. Your likes of your Googles and things like that, that at the end of the day just make billions in cash flow. They've got a very, very healthy balance sheet. They've got hundreds of billions sitting in the bank. These are companies that just dominate their market, and they're only going to go one way over time. Where they're going to
Yeah.
be over the next 6 months, who knows, right? It all depends on obviously what goes on in the crazy world that we live in. But over time, they're always going to end up higher, right? So that's the way that I like to look at it from an individual name aspect. But then obviously the core of my investing is diversified, like I said before. And what I've done is here, I've just kind of created a very, very simplistic example and the differences that you can end up with. If we can kind of compare the volatility that you could have, let's create two portfolios here. So imagine we had portfolio one that was 50% in stocks. Then 25% of the rest of the capital was in a 10-year treasury, i.e. government bond, basically, and the other 25% was in gold. And if we
Yeah.
compare that to a second portfolio that was 100% stocks, we can actually then run like a back test on this, how it performs over time. And obviously the 100% stock portfolio is going to outperform. It's made about 10.49% per year compared to 9.9 for the diversified portfolio. But the difference is really in like the volatility and things like that. So you look at a standard deviation, which essentially measures
Yeah.
the range that we move in,
Peak
basically
to,
over.
peak to trough, right? Peak
Yeah,
to trough.
exactly that. Your peaks to trough essentially is your range of movement over time. The S&P 500 or the stock market is just under 16% per year. You get yourself down to under 10% per year if you're diversified, just in that simplistic method that I used there. Your worst year would be down 37% for a stock market, only down 13.5% for a diversified portfolio. And your max drawdown would have been over 50% if you was 100% stock. So that's back in like the financial crisis, etc. But only down 20%, in a diversified portfolio. And that was actually only in 2022. If we go down here to say 2008, when you was down 37% on that year with a financial crisis and everyone thought the world was ending, you was actually only down 12%. In your diversified portfolio. And you can see here the annual returns, that you can see how rarely we have a blue line to the downside, which is a negative year for a diversified portfolio, and how little it is each time, right? So
Yeah.
as we said earlier on, the goal of a diversified portfolio isn't to make the most to the upside, because at the end of the day, it's impossible to make the same amount as the best performing asset, right? Because the other assets are naturally underperforming in terms of total return. But what we end up with is those assets stepping up and performing very well during times where the S&P or the main performer hasn't done. So a good
Yep.
example of that is 2008 financial crisis, markets are cut in half. Well, if you was investing in bonds were up that year. So they now
Sure.
offset some of that downside. Gold, for example, more recently, bonds have been lagging a little bit. Yields have been bobbing up and down. Stock market's been moving lower. Gold just keeps pushing higher and higher and higher. And that's why, like with my personal portfolio, I'm up this year because about 25% of that portfolio is invested into gold. So there's obviously so many different ways that you can break it down. That's a very, very simplistic example. You can then have fractal diversification on top of that, i.e., if 50% of your portfolio is stocks, you could then maybe go into different areas of the market, small cap, large cap, mega caps. You could obviously have individual names, different sector ETFs. You can, break it down within that as much as you want. So you get different types of diversification from that point. But the idea of an example like that is it just goes to show how much of a benefit you can have, because at the end of the day, that's going to be a lot less stressful, and you get as
Yeah.
near as makes no difference the same returns. You only lag by about 0.5% per year in terms of return over time to the upside. So what you're giving up in terms of upside gain is very little. Now, if I was 20 years old, I would not be probably diversifying like that. I would be putting everything into stocks for the long term, compound. And then as I get older, I would start to diversify more. Like I'm about
Sure.
to turn 34 in a couple of weeks. I'm starting to diversify a little bit more and things like that, because I want less volatility. Growth isn't the most important thing. We always want appreciation of our capital, but it's not
Yeah.
the be all and end all, right? I'm looking to also have more steadiness and stuff like that over time. And especially if you was even older, 50, 60, things like this, you don't want to risk a 50% drawdown in your retirement pot. You want to be diversifying it nicely. So it's just a great way and a great option of doing it. if only with a portion of your capital, not all of it.
Yeah, I agree. I mean, there's some nice. I've been now that you're speaking about it, I actually might start to maybe put 5 to 10% of my dollar cost averaging portfolio into gold. I'm looking at this gold ETF that they have on my investment platform. It's up, actually interesting. It's up 26% year to date. I mean, maybe you would have protected some of the downside on that I've experienced on this year. So, but obviously I'm in my 20s still, so maybe I can be a little bit more aggressive on going for your Nasdaq ETFs, your S&P 500 ETFs, your MSCI World Fund feeder fund ETFs, and then maybe when I hit 30, maybe I can start allocating more into like a gold ETF. So, maybe your more mutual funds that are more managed ETFs, stuff like that. Right?
Exactly that. And when I think the main thing to remember is, I think where a lot of people go wrong with diversification is they just buy lots of things. You could, I've just showed you there, have 3 things, because you could have an ETF version of each of those and be more diversified than someone that owns 50 things. Because what it comes down to is the level of correlation that you get between those assets. If you've got, for example, real estate, i.e. property, and you've got stocks in your portfolio, well, they both perform typically well and not so well in the same type of economic condition. So owning both of those, you aren't really diversified. Now, they have different pros and cons. Like you can, depending on the type of real estate investment you've got, maybe get a slightly higher yield compared to, say, like a stock market ETF, for example, right? So there's obviously different reasons why you might have them in your portfolio. But if we're talking about from a diversification aspect, they don't actually provide any diversification because they will both perform exactly the same in more risk on and risk off markets. So you have to be looking at the level of correlation of the assets that you own when you're diversifying. And little websites like this, Portfolio Visualizer, and that, they're great because you can run back tests and change the numbers. And right, well, what if I owned this and I own 20% of this in my portfolio? And blah, blah, blah. Because this is data, as you can see there, going back to like the early 1970s.
This is like a back test, but for portfolios.
Yeah, exactly that. And you can run all sorts of things on here, by the way, but this goes back to like the early 1970s. And like you can see that growth portfolio growth line there. The dark blue line is the diversified portfolio. And you can see how much smoother that is over time compared to 100% stocks, which does end up bigger, but you can see how it has these bigger dips and rallies and that around it. So what we said earlier on in terms of tightening up your range of distribution of returns.
Sure. I like that, bro. This is pretty neat. I think I would like to continuously do another episode. Maybe next week, Ben, we can record another episode. What I would actually like to do for you guys watching. So, Ben, I'm actually doing free webinars and that on the weekends. I've been building up a small group of guys that I do it for free. And maybe we can actually speak about this. Most of them are in South Africa. But I think that getting you to come on and speak about that could actually be quite useful for these guys. Because I think a lot of guys are wanting portfolio advice. That's where they can come to you one-on-one. Mm-hmm. You do one-on-one portfolio advice, services for that, right? Is that correct?
Yeah. So I work with people on a one-to-one basis. I don't really do kind of like courses and stuff like that nowadays because just purely personal preference, really. For what the majority of what people tend to come to me for is more tailored stuff around their personal situation. So it just works better that I just work with people on a one-to-one basis. So either like, bi-weekly or weekly, we'll catch up, have sessions together. We go through their particular holdings, what their view of the world is, how they're diversified, how much money they got in this, how much money they got in that, why they're in it, all these sorts of things, whatever it might be, obviously tailored for them, because everyone's going to be a little bit different. But yeah, I'm more than happy as well to jump on and do some bits with yourself as well.
100%. Ben, I appreciate that. I'll put make sure to go follow Ben. I'll put all these social medias below: Twitter, Instagram, Tinder profile, TikTok.
My OnlyFans link.
Grindr profile.
Yeah, they're all. Yeah, make sure you get it all out there. We've got to make sure we fully advertise.
Ben, I always appreciate your time, and if you guys have enjoyed this, comment below, and I always enjoy the chats with Ben. It's always interesting because no matter what you're doing, if you are a day trader, you are a businessman, you need to have a long-term portfolio that you are actually, I'd say, managing yourself. It's becoming a day and age where it's not like, okay, you need to phone a broker to go buy a stock. No, there's DIY investment portfolios, and that I think everyone should be doing. So appreciate your time, Ben, and we'll see you on the next one.
Pleasure as always.